When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Fogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Fogan. And now here's Jeff Fogan and Jeff Shea.
Thank you so much. Welcome to Premier Retirement with Jeff Fogan, the founder and president of Premier Retirement Planning and Wealth Management in Tucson and Mesa. We are the radio show that gives you that straight talk and honest answers that you need to help you reach your wealth management and retirement goals through smart investing and careful planning. I'm Jeff Shade. I'm just here to ask the questions, but of course the words of wisdom and solid advice, they do come from Jeff Fogan, founder and president of Premier Retirement Planning and Wealth Management. Hey Jeff, how you doing on this Saturday morning?
Well, I'm doing great. It was a good week. I was, kind of nervous up to Tuesday, but I'm feeling a lot better about things, obviously, after the election.
Well, that's what we're going to talk about here in the first part of the program is the Trump victory here. So what does this mean, do you think, for the future of America going forward here in the next 4 years? But in particular, what does this mean for our listeners in terms of their investments into equities and just, putting them on a better path for the growth of their portfolios and their retirement plans?
Well, as I've said many times, I think the last 4 years has been difficult for the economy, for the average person. In the last 2 years, we've really been more or less in a recessionary state with inflation or even stagflation. The growth that they say is happening and the jobs numbers that they say is happening are fake. They're government spending, they're government jobs, and typically manufactured numbers to make things look like they're good. But the American people didn't feel that way. And it was a referendum on Tuesday night that, hey, America is not going in the right direction and we need something that will give us real reason for market increases. And I said, and the reason that I was so timid about trying to jump in the market just because it was going up is because there were no fundamentals or reasons for it to go up. Now, Donald Trump's policies and his monetary ideas and his business acumen is going to be very good for the economy from the standpoint of turning around what's broken. And, Kamala broke it or Biden broke it, I'll fix it. I hope his plans work. I think his ideas about lowering taxes are going to be the same thing as stimulating the economy. Instead of printing money, you actually leave the money in the system to work and to compound and to turn over multiple times. Every time somebody buys something, that person they buy it from can buy something, and that person can buy something, and that person can buy something. When you take it out of the economy and call it a tax and pay a bill with it or throw it down a Green New Deal or some sort of entitlement program, it's given away. It's gone. That money is gone. It's not circulating. It's not generating jobs. It's not generating commerce. It's not generating purchases. It's not generating any type of wealth. And it's definitely not generating taxes anymore. You get a tax at once and it's gone. That's the Democratic theory. It's just like taxes, just a one-time, it's just a single math equation. It doesn't use compounding returns or turnover or the fact that you can get taxes multiple times on the same dollar if you leave it in the system. And that's what lowering taxes does. So it's just like money printing without printing money. He can get Elon Musk in there and start lowering costs and basically lopping off, wasteful government spending. He knows how to run a company. Electric cars, didn't start out with robust sales like they do now. I think it's kind of funny that, Tesla stock, I think, went up $40 on the open on Wednesday morning just because Trump won. And Trump's like anti-electric car guy. So I thought that was kind of interesting. But the fact is the economics are going to be better. Tariffs on foreign cars like electric cars from China, Japan, Mexico, anything that's built outside of America is going to have an added tariff. That doesn't mean just because it's a tariff that goes up 60% doesn't mean the price of that car is going up 60%. It just means the wholesale price is, which is kind of that thing I think people misunderstood is tariffs are going to ruin America. No, they're not. They're going to create better economics for the companies that do business here because they're going to be able to, keep their prices the same and maintain a little bit more profits, or they won't have to outsource so many things from other countries. They can actually build them here cheaper. And even if the prices go up a little bit, there is a certain thing called healthy inflation. And if the economy is growing, there's a level of inflation where, you should be able to increase the value of everything based on the extra work or technology that you put into it. And that's what we've seen over the years. But, that rate of growth and that rate of inflation should be around 2%. And the growth rate should be, 6 or 7, like 2 or 3 times that. Now what we're seeing is inflation at 3 or 4% and the growth rate at 2 or half of that. So it's flip-flopped and it's backwards. Yet somehow everybody on the news says, oh, it's going great. The economy's good. Well, I think the American people can feel it and they know that it's not. And so, I was really amazed that we had pretty much a mandate, a referendum on the old system and, welcoming in the new. We had, Hispanics and blacks, voting in unprecedented numbers and ratios to Trump, to be called a Nazi and a racist and everything else. He's pretty bad at that. If he got all those extra votes, he didn't make his case very well if all those people that they say he's trying to hurt are voting for him in droves. So I'm really happy about the footing that America's on. I'm really surprised that the Democratic system didn't rig it, but I think it was too big to rig this time. There's just too much going the wrong way. 75% of Americans thought it was. And it's going the right way. I think just the feeling, and you can hear it in my voice, just a feeling of, I think, confidence, the feeling of, okay, maybe we're on better footing. We can have confidence in markets. We can have confidence in economics. We can have confidence in the growth. However, with that said, there's still been a lot of damage done. And there's still a lot of inflation that hasn't gotten back. Prices are still up. We're still not energy independent. There's a lot of work for Trump to do to fix stuff. And it's not just going to happen overnight. And I think the euphoria of the market just blasting off the next day is a sign of confidence and a sign of optimism and a sign of goodwill. But I think the reality is we still have to see earnings come back. We still have to see all those policies that Trump needs to undo from the Biden administration and redo for the new administration is going to have to take effect. And it may take some time, but I think it gives us a better chance, even though we're in a recessionary cycle that usually ends badly. I think now we do have a chance of a soft landing. I've always said it's kind of minimal. We've only had one of those in the last 100 years, every time there's a recession cycle. And, they've been putting it off by manipulating the market, by printing money, kind of through the Fed and the banking system and, kind of hiding QE from us and pretending that they're tightening the system by raising interest rates for a while. Then they lowered interest rates. They didn't really even lower them. So the gamesmanship is going to stop, I hope. I know Trump wants the market to look good because it'll make him look good. And I know that there's probably very susceptibility for any party that gets in power to manipulate in some way to create the opportunity for the market to do better. But I think his policies will be more economically sound, more in favor of the people, and I think it will get us back on a good footing. And I still am not going to walk back because it's still too early. We haven't even had the inauguration yet. We still don't even know what pushback we're going to get between the exiting party between now and the inauguration. Well, hopefully it'll be peaceful and orderly, and we won't have riots in the street by the sore losers that sometimes the other side can be, and so anybody can be. But I think they act out differently, and I hope it doesn't happen. So anyway, I'm very optimistic about the future. I didn't jump right in the market Wednesday morning with my clients' money. We have to kind of see how things settle out. We have to see what the opposing party is saying on their way out. There's a lot of tricks they can play between now and the inauguration to kind of screw the market up for Trump if they're vindictive, and we know that they are. They've tried to put him in jail. They've, people have tried to get him shot. There's a lot of opposition, and I think it's not going to be just an easy transition. I think there's still going to be some things to be careful ahead, and I'm cautiously optimistic. Let's just put it that way.
Jeff, 2024 is not 2016. What do you think Donald Trump needs to do here in the coming year when he takes office in 2025 to put us on a sound financial footing, and particularly to influence our listeners here of our program today in terms of growing their wealth and preparing themselves for retirement?
Well, he's going to do exactly what Biden did, and that is with a stroke of a pen, wipe out the stupid things that Biden did, even though Biden wiped out all the smart things that Trump did, and Trump's going to put back in the smart things that he had in place, like, remain in place in the Mexico border. He's going to finish the wall. I hope so. He's going to make energy independence. He's going to open up drilling in Alaska and all those fields that were closed down. He's going to extend the pipeline. There's going to be a drove of people that are unemployed right now going back to North and South Dakota for the oil fields and all across America, wherever that pipeline goes through. I don't even know what the route is, but it's up and down the U.S. So I think that's going to end up becoming a reality. I think he's going to put back in place. Just the immigration situation. People are arguing about the tariff situation. He's going to implement tariffs. Guess what? He might increase tariffs, but you know what? Biden doubled down on the tariffs. They like the tariffs. So I think it's kind of interesting that if they think the economy did so well and they increased tariffs and it didn't kill us and it made Bidenomics work, supposedly, when it didn't. The thing is they increased tariffs, making it harder to buy foreign goods at a good price, which caused inflation. But they also were the economics was so bad that the local economy could not produce. Manufacturing went down. Now, generally speaking, when you do tariffs, but you open up, you decrease regulations on businesses and you make it easy for them to do business, and you lower taxes instead of, say you're going to raise them this first chance you get to 28% instead of max out at 21%. That's a huge amount of money that you can't put back into your businesses. Now that Trump's back into place, I think businesses will have a lot more confidence to produce their own goods, so that those tariffs on the foreign goods are going to only help American producers produce more more, create more jobs, increase wages to try to, get us back into a place where we can afford the things that have already gone up so much in price that we can't afford now as a typical American person. Not me personally but the typical American people are having struggles, the more than 50%. And that's why we saw the vote come out so much in Trump's favor. So I think there's going to undo that. And the other thing is he's going to put good people around him. And some of the big things that he understands. Oh, by the way, he'll probably extend the tax cuts that he put into place in 2017 or was it 18? But, the Trump tax cuts that, saved everybody. There was a certain amount of people. I mean, I actually had my taxes go up because I don't get exemptions and deductions and things like that. So, I paid a couple extra thousand in taxes, but, the economy was good enough that I made more money, so it didn't bother me, right? So I think that's going to help. And it does actually help the lower middle class save a little bit more because they do get extended deductions generally. And I think businesses are going to thrive better with, a better tax situation, going more confident into putting money back into their business and back into the employees' paychecks and things like that. So, and the other thing is the people. The first round, Trump didn't know who to pick. He'd never been in politics. He'd never rubbed shoulders with these people. He assumed that the people in place were competent, that they were put in there because of their expertise and experience, but they weren't. They were put in there to be political pawns, puppets, and in many cases, just unelected bureaucrats that got in the way, caused messes, and basically, built walls against the opposition for the agenda that, the more liberal party wanted to push forward. And we know that most government workers, the Democratic Party typically likes big government, and they like to be in control of more things. And so typically they lean left. That's a fact. And I mean, I'm not trying to be making a political statement, just an observation. And I don't think, Trump knew that there was such an established system that was going to be hard to overcome. He also didn't know that the people he picked, in many cases, weren't necessarily focused on America, but they were already bought by some agenda prior to his picking them for cabinet positions. And that's why so many of them, even generals in the army, were, turning their back on him because he fired them because they weren't competent. They weren't supportive of him. They weren't supportive of the Trumponomics that, he wanted to grow. They were more supportive of their own agendas or their own liberal agendas that they supported, long before that. So I think he's learned a lot. He's had 4 years off to do a lot of homework and to get to know people that do support him. He's bringing in Elon Musk and Vivek Ramaswamy. Both have run billion-dollar businesses, and they know how to cut costs and run businesses. They know how to get rid of the fat. And, if we could run the government like a business, we'll all be better off, period. So, I think those are the things that he's going to focus on, and I'm excited to see how it works. And, what's really cool about that is I think companies in America, even though a lot of the big tech companies are run by flaming liberal, way left-wing cultured people, I think they're going to be surprised that their business is going to thrive under Trump because of, I guess, maybe less regulations, maybe some tighter regulations when it comes to, foreign adversarial countries competing or working with us on a non-effective basis. But I think they're going to all find out that they're doing better under Trump, too. And who knows? But the bottom line is he's got a coalition built not only just of a bunch of American supporters, but I think he knows who to hire around him that will help the agenda to seriously make America great again actually work. And I think in the next couple of years, we will see earnings return to where we can actually buy stocks and the growth of stocks and count on the growth of stocks based on fundamentals, which we have not been able to do for several years.
We're talking with Jeff Ogen of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We've been talking about, of course, the election of Donald Trump for a second term in the White House. If you'd like to get in and sit down with Jeff and talk about how this Trump presidency may affect you and growing your wealth and your journey towards a confident retirement, you can do that by calling 520-780-9059 and request your Premier Retirement Roadmap. Not going to cost you anything at all. No obligation whatsoever. Chance for you to sit down and ask Jeff things such as, how is the Trump presidency going to affect me and my journey towards retirement? What about my investments? Where do I go from here? How do I plan a confident retirement? How do I not run out of money? How do I pay for health care? How do I, do estate planning? There's no question off limits at Premier Retirement. So once again, 520-780-9059. You can also find out more about us online at premret.com. That's PREMRET.com. Jeff, every week here in the radio program, we do talk about a case of the week. So did you have someone who came in last week, a unique case that you can tell us about?
After doing this for about 30 years, I find that there really aren't any unique cases, but there are certain trends or certain things that happen that remind me of things that I think we do that sets us apart. And so I'll just go over one that kind of triggered this as part of my philosophy and way of thinking. And what we're going to talk about is somebody that has actually been listening to the show for a few years. They came in and they had a situation where their advisors kind of really not much of an advisor. Now, these people have done very well, good pension, been retired several years. Their investments continue to grow because they've been mostly market-based. The thing is what they were finding, and I guess the reason that they ventured into our office is because, when they call the advisor, they just get, oh, just hang in, just leave it there. And then if the guy says, I think I have too much Apple, can I sell it? Nah, that's just our model, just leave it there. Or, hey, what about these AI stocks? Should we add some AI stocks? Oh, no, you're doing pretty good. Why not just leave it there? And this is a typical answer. And I find this to be very common from people that deal with registered investment advisors that, call themselves fiduciaries, but all they do is plug and play a stock and bond model. Now, for growing wealth, I think it's great to plug and play a stock and bond model where you have a diversified portfolio. Maybe you have some, not even the bond market, but just go into an aggressive type of a strategy where you dollar cost average into the market and grow your wealth. I think the stock market has proven to be a good place for that over a long-term period of time. Especially when you're, loading up 401ks and things that are tax deferred, and you can do it without really causing any tax damage. But once you get retired, there becomes a couple of different things that come around. And that is, first of all, volatility kind of stinks if you have to pull money out of your IRA. Now you might think, well, I don't have to pull money out of my IRA. I've got a big pension and big Social Security paychecks, and we don't really need that money. So you put it off. But eventually you will have to pull money out. And this particular client that, kind of jogged my memory of this type of scenario where I get a lot of people that come in and, they've kind of kicked the can down the road because they've got more money than they need to spend. But all of a sudden now they find themselves in a big, huge tax situation where now they have to pull the required minimum distributions for this one particular couple that I'm referring to is over $100,000 a year. And it's because of their age, and they're going to get older, and their account continues to grow at a pace bigger than 4%. I mean, shoot, interest, you can make more than that. And the required minimum distribution when you first start taking them is around 4. Then it goes up to 5, 6, 7. By the time you're around 90 years old, it's 10%. And by the time you're pushing 100, it's like 25 or 30% of your account has to be withdrawn in tax. So those taxes get forever worse and worse. What doesn't happen is nobody tells these people about taxes. Nobody plans for anything other than, just park it and hold it, just let it grow, and just pay me a fee. And by the way, I like to golf, and I probably won't be here to answer your phone calls, but I'm out partying with my buddies, and thanks for the fees. You've got millions of dollars with me, and I'm really happy to collect fees and not do anything. And that I hate to be kind of sarcastic in the way that I'm presenting this, but I get this feedback a lot from people, in town, out of town. Sometimes it's people that have moved from someplace and they've kept their advisor in Iowa or Illinois or New York or California or Oregon, wherever they come from. And now that they're out of sight and out of mind, they're really not treated as important. And all they do is the same strategy that they did to get to retirement. The stock market does go up and down. Now, if you have millions of dollars, it doesn't probably matter and doesn't change your lifestyle. But what if you only have $500,000 or a few $100,000 or maybe $1 million that, you really can't afford to lose half of? Is just park it in the market and see what happens, because over time it does well. Is that really the best thing for you? And my answer to most of my clients that don't have millions and millions of dollars, or, more than just a nice amount saved that can get them through retirement if they don't lose it, many people don't. So they're not really getting the, and then when people question the advisor, hey, should we take less risk? Oh, no, it's doing pretty good. Let's just leave it here. But the thing is there's a lot of writing on the wall that says the market isn't going to keep doing this well for a long time. If we look at history, and I've mentioned this in other shows before, it's overvalued. It's historically, we're paying a lot more money for each dollar of earnings than, we've paid historically, I think, ever now. And there's only two other points of time that mirror that, and that is right before the Great Depression and right before the dot-com bubble busted and made the dot bombs. So, I don't want to be in a place where, if you are concerned, all of a sudden, we're just poo-pooing it and saying, just stick the course and thanks for the fees. I think a financial advisor ought to earn fees. And there was a recent study that said people that use advisors typically make more money. It's like about 2 to 2.5% compounded annually more than the person that tries to go it on their own and just park it. So I understand why people want to delegate and use an advisor. And by and large, an advisor can kind of talk them down off a cliff during growth periods and, during crash periods. And sometimes you need a little hand holding. I get that. But if it doesn't include, making sure that you're prepared not to lose money, and it doesn't necessarily mean lose money in the stock market, but lose money in taxes because you waited too long to take your RMDs, or you didn't do a Roth conversion when you were in a lower tax bracket 10 years ago, but now all of a sudden you're never going to be in a lower tax bracket because you've doubled or tripled your money in the market, and now you've got big RMDs. I haven't have any problem doubling or tripling your money in the market, or even slow and steady index annuity and things like that we use. Some of the things that are a little safer, more kind of the tortoise in the race than the hare. But bottom line is typically people with assets have more problems than just how we're going to allocate. And most people that have money and are retired, want to protect that. But many people are not getting the right feedback or comfortable feedback from their advisors. I've got several people that have come to me from another advisor that many people know about. In fact, I think I get one or two clients from them a week come in and talk about, like, I signed up with this company. I heard all their ads. They sounded like they really wanted to be a fiduciary for me and do the right thing. They stuck me in a portfolio of this, that. They sold me a couple of annuities. They stuck me in a portfolio, and then they shipped me off, and I've got to talk to some dude in another city, in another state, in order to get any account help. That person doesn't know me. The guy that signed me up and rolled my money is off getting a new client. They're just basically enrolled agents. And so I guess this appointment reminded me is there's a lot more to being a fiduciary, I think, than just parking money in an account and charging a fee for it and calling yourself a fiduciary just because you have a license that says you can. I think being a fiduciary, it fits a lot better situation if you're more of a boutique organization like we are, where you can actually look at the person's actual desires. You'll actually answer the call yourself or respond to an email when they say, hey, don't I have too much of this particular stock or that? Or, hey, can we go a little bit more into now that interest is higher, maybe we should take a little bit more look at short-term bonds that pay 5% rather than, stocks that are going up, but could crash 50%. I want to preserve my assets and be able to respond to that. Or, hey, my RMDs are going to be $150,000 next year or $40,000 next year. I'm going to be in a higher tax bracket. Is there anything I can do to save my taxes? Well, another thing about this particular client that has these huge RMDs that they're forced upon them because now they're in their 70s, they can't really do anything about the RMDs unless they want to just in one big fell swoop, take all their money out, convert it to a Roth and pay tax at, 38%, which honestly might not be a bad idea if they're already going to be in the 30-something tax bracket forever, and who knows if it could go up. But I would never necessarily suggest that now. But man, 10 or 15 years ago, we should have done a kind of a methodical, a program where we would have systematically moved some of that money into Roths, pay the taxes at a lower bracket so we wouldn't be burdened with that. Now, the other thing is a lot of that money that's been coming out that they haven't been using has gone into just a joint regular account. Now they've kept that account by and large conservative, mostly interest and dividend bearing accounts making 5 or 6%. Happy with 5 or 6% when you have millions. In fact, most people are happy with 5 or 6% if they don't want risk right now anyway. Shoot, CDs were only like 1%. Now keep in mind, it doesn't have to be millions. It could be hundreds of thousands. It could be just whatever you have. This just particular case has a bad tax problem because they've saved well and they have, a decent amount of money. They do have millions, but they have millions in their non-IRA accounts. Guess what? They don't even need to use those because they have to take so much out of their IRAs and pay taxes on. They just let their joint accounts grow. Well, in mutual funds and interest-bearing accounts that pay interest like bonds, they've got a tax bill of $70,000 or $80,000 a year just in taxes on that account. Well, shoot, how do you get rid of that? So guess what? There's things called tax-deferred accounts. We use LIRPs, life insurance-based products. We also use annuities, which are tax-deferred. Now, you could say, well, yeah, but that'll just kick the can down the road for my kids. Well, if you're already in a 35% tax bracket because you have to take hundreds of thousands of dollars out of IRAs, or at least 100, and you're in a kind of a predicament there anyway, plus you're paying tax on this interest, why not defer it? Maybe you use that money for charitable gifting. Maybe you use that money for paying for grandkids to go to college and get the tax write-off for paying tuition directly. Maybe when you have a medical need and you have to come out of pocket for some of the deductibles, or heaven forbid, a nursing home or some sort of long-term care issues, you can pull it out of those accounts that have been deferred and you get a tax deduction in the years that you use it. And what if you have 5 kids and 13 grandkids like I do, and you want to leave a little piece to everything, and you have, let's say you have a couple $1 million in unrealized gains that you never had to pay taxes on, but you get to split it up 18 ways so that each person out of a couple $1 million, each person gets a couple $100,000 and they can take it out over a period of 10 years if they want to. You're not going to cause a tax burden for the people that you pass that money on to, but you're going to certainly have a tax burden by not compounding the annual gains in an account that generates interest at 5 or 6% on bonds or even CDs. You pay taxes whether you use the money or not. I mean, if you're making interest, you still pay taxes on it, and that money has to come out of someplace, and it doesn't compound, it doesn't grow your wealth, and it doesn't end up being part of the legacy that you leave your kids. So, I like the index annuities that I talk about all the time. Is a great place to defer assets. So if you've got, like this client did, pushing a couple $1 million out of IRA money, and all of it's causing them a tax problem, and they don't even want to get interest because they know they're going to have to pay taxes on it. Well, that's kind of a bummer. I mean, I think you should. If you have to pay more taxes, it means you did make more money. It'll make you sick to write that check to the IRS for 6 figures, right? But, when you could defer. And by the way, there's a lot of ways, like in the index products that I've talked about so many times, where you can make a lot more than 5 or 6%. And if it's tax deferred, you end up giving a lot more money to your heirs, have a lot more flexibility, and you save a lot of taxes along the way. So being a fiduciary is a lot more than just parking money and charging a fee for it. I think it's more comprehensive, and I think people that come here realize that you're not just a number in a big organization.
Jeff, I think the takeaway from this conversation is that if our listeners are looking for a hands-on advisor, somebody that you can speak with, you can reach, somebody who's going to be responsive to your questions and your needs, I want you to call and request your Premier Retirement Roadmap right now. 520-780-9059 is our telephone number. Leave your name and number. Shelley will call you back during the week and set up that appointment. Why would you want to deal with an advisor who's going to pass you off to someone else? The advisor that you talk to at Premier Retirement is Jeff, and he's the advisor who is always going to service your account. So get the personal attention that you deserve by calling 520-780-9059 and requesting your Premier Retirement Roadmap. You can always find out more about us online at premret.com, premret.com. Jeff, when we come back, we've got listener questions, and then we'll continue our conversation. We'll finish it up from last week on 7 ways to invest for income when our show continues here on 790 KST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shade.
We so much appreciate you joining us each and every weekend for Premier Retirement with Jeff Fogan. My name is Jeff Shade, and a little reminder, we're on for you 4 times a week in the radio. Saturdays at 7 a.m., also 9 a.m. and 1 p.m. Sundays at 11 a.m. And as always, if you've missed any part of the program, you want to hear the whole show again or listen to it on your schedule, we're also a podcast. Go to wherever you get your podcast, search for Premier Retirement with Jeff Hogan. You'll find this show and all of our past shows so you can stay on top of your journey towards a confident retirement. You can also Google that. I found that to be quite effective. Google Premier Retirement with Jeff Hogan, and it'll point you to one of the many places that you can hear our podcast. Okay, Jeff, every week we give our listeners a chance to talk back to us. We'll kick it off this week with Max listening to us in Tucson. Max writes, I'm 65 years old. I have $600,000 in savings, and I'm very close to retirement. Where should I park my cash now that the Fed has started cutting interest rates again?
Well, if the Fed was really cutting interest rates, as in long-term interest rates, you'd see bonds go up 5 or 10%. Instead, we've seen them actually go down. Interest rates are actually going up, and prices are going down. So the Fed hype about lowering interest rates has only taken place on like Fed funds rate and the overnight rate or the short-term treasury rate. Some money markets have gone up, but in reality, interest rates are continuing to go up. It's one way that they're continuing to fight inflation. They need to do that. But the thing is, you're not getting the whole story from the Fed. If you look at bond prices, and there's just one ticker you can look up and see what I'm saying, is TLT. TLT is the 20-year treasury, 20-year long-term treasury that will show, a very nice increase in prices as the rumor of rate decreases was going to happen. In fact, we put our clients in the longer-term bonds knowing interest rates would go down and knowing bonds would go up. Bonds are down about 20%. The overall aggregate bond market is down 20% or so, since the market crash of 2022, because interest rates have gone up, making the price of bonds go down. It's kind of like a teeter-totter. One goes up, the other goes down. And they haven't recovered yet. I expect that they should recover as interest rates or as inflation gets under control and as they actually are in a position to lower interest rates at least a little. I don't think they'll go back to 1 or 2% like they were, 5 years ago or even 3 years ago. I think, they'll probably settle in the 3-ish range, probably instead of the 5 or 6 range. Or, the long-term bonds are now, kind of the low to mid 4s, which way back when were like 2-ish. And now they're 3 to 4 and they're going up, not down. The short-term interest rates are over 5, and those are the ones that, went down a little bit, but even those are getting bought up because people are running to safety because they have some fear of the market. So if you do have savings, I think the shorter-term interest you can get is the better. It's more liquid. And if they're going to cut interest rates, they might cut it on the short-term bonds. But if they do actually cut interest rates on long-term bonds, I would put money in bonds and use them as an investment tool because they will increase. I mean, if we went back to a 0 to 1% rate environment on short-term and a 2 to 3% rate environment on long-term bonds, we'd see those bonds go up in value 20 to 30% from where they are. Well, if they went back to 0, go to 20, 30%, I still think there's about 10 to 15% upside just in the bonds on the price of the bonds in a bond ETF or a bond mutual fund. So, if you're looking at not being in the market because you're worried about the market, there are some plays, although they are volatile. Anybody who's played the bond market lately knows that. Or you can just, parlay it in a short-term, anything less than a 3-month bond portfolio. It's typically a money market rate over 5%. You can do it on your own retail. You can hire an advisor to, steer you to the right directions. There's a lot of leveraged short-term plays where they use options to enhance the returns, and some pay dividends of, anywhere from 8 to 10%, on top of potential growth. And some of these have been growing. So there are some ways to play it on a low risk or a no risk approach without taking a lot of risk. And I think if you're 60 years old, you have 600,000 in savings, that's a nice number, but it's not a nice number if you lose half of it, or even if you lose 20% of it. It's a nice number if you can make sure that it grows. And if at 5% it can grow, you don't have to spend any principal and you can live on $30,000 of extra cash flow from that. And right now you can get that. I think as far as trying to diversify into the market, I think it's a real risky game for a person at your age and with limited assets. I mean, if you had $6 million, risk half of it. Who cares? You can lose half and you'll still be okay. I don't know if 600 is the only thing you have, if it's savings, or if you still have an annuity that's going to pay you $50,000 or $60,000 a year too. If that's the case, maybe you can risk some, or maybe you wait till the market corrects, like it will eventually. We just never know when. We just know it always does what it's supposed to. We just don't know when. But as far as savings, cash now, I think short-term CDs or short-term bonds, if you can get more than 5%, you're doing well. And I think it's a great fixed rate. I think you'll actually probably beat the market if we factor in a couple of, post-election volatility issues and a couple of corrections along the way, and maybe even a big crash that we're due for. So I think you'd be crazy to go in the market. I think you're looking at the right thing is just maximize your interest on short-term savings.
Max, thanks a lot for listening to us in Tucson. Of course, we'll send you out Jeff's book, Retirement: The Road Ahead. Okay, Jeff, next question is Randy listening to us in Dub Mountain. Randy says, when entering retirement, would it be best to transfer your pension fund and 401k from your employer account to your own personal individual retirement account, keeping them under one roof?
Well, I think not just when entering retirement, as soon as you're 59 and a half, almost always you have availability of that 401k money to move to an IRA. Now, some people will say, oh, yeah, but the 401k's cheaper, the fees are lower. Well, maybe they are, maybe they're not. If you look in how many layers of people get paid, it might not be any cheaper than a mutual fund you could buy on your own. It might not even be cheaper than having an advisor manage those funds and use load-free ETFs instead of mutual funds and things that not only pay a fee or a commission or a back-end load or a front-end load, but have high expense ratios as well. So you can avoid all that. You have more options with an IRA. And the nice thing about IRAs is you can use all kinds of stuff. I mean, you can, hold gold and silver physical if you want to. I don't necessarily like that, but you can. 401ks, I've never seen that option available ever. You can have annuities in a 401k. You can't have annuities in a 401k, but you can in an IRA. Some people like to set up an annuity that's going to guarantee them a pension income when they retire in 4 or 5 years. Maybe if you're 59 and a half, you want to do that now so that when you're 65 and decide to retire, you already know exactly what your income is going to be several years from now. And then, all the money that you put into your 401k between now and then can be dollar cost averaged into the market, and you can still have the upside of the market. And by the way, when I say the word annuity, don't think it's a bad word. I had 3 different annual reviews this week that had annuities that were a year old, and they're up between 12 and 20% for a year. So don't think that just because it's an annuity. By the way, these are principal protected annuities. You cannot lose principal. And when the upside locks in, that is now your new principal. So you can't go backwards. And because these products act that way, companies are willing to lock in profits along the way and guarantee you at least a minimum rate of return on your investment and a minimum guaranteed income in the future. So you can't do that in a 401k. The other thing you have in a 401k is they have mandatory automatic withholdings. If anytime you take money out of a 401k, they withhold 20% from it. Well, from an IRA, you get to withhold however much you want or nothing if you want to. Maybe you want to pay taxes next year, or maybe you're pulling money out of an IRA in order to pay, for medical expenses or tuition for a child or something that is going to be a tax write-off. But the 401k yanks the money out before, and you have to beg for it later. You have to use it as a credit towards your taxes next year. Well, that means you have to pull out more money from your 401k for those withholdings, get taxed on a higher amount just to have that tax credited back to you later. Individual IRA accounts are far more flexible. You can do more things with them, buy different products and services with them, and keeping them under one roof. Well, yeah, when we manage people's assets, if they're still working and have a 401k, we typically manage most of the IRA money, draw it down to a minimal amount, and they continue to add to that 401k. And when they retire, we'll roll the rest, or along the way, we'll just roll chunks out of it and keep adding to the IRA and grow those accounts in those diversified assets that we have available outside of 401ks that 401ks don't provide. Randy, thanks a lot for listening to us in Dub Mountain. And again, we'll send you out Jeff's book, Retirement: The Road Ahead. Next question, Jeff, is Terry listening to us in Oro Valley. Terry says, I'm in a quandary about how to invest $750,000 that's in my 401k. I'm 67 years old, retired, and I've not started taking Social Security yet. What's the best way to preserve this money for the rest of my life that doesn't have high fees? Well, I think you should not worry about fees at all. I'm not saying that there aren't high fees. High fees are when you don't get something of value. There are some people that think, oh, I'm paying high fees. I don't want to pay fees. Well, if you're a fee weenie, you might not get certain leverage. For example, there's an annuity program that has a fee of 0.95%. Actually, it's 0.75% spread. You get the rest of whatever they make, but they leverage the interest they make on your money 3-to-1 on an ETF you could buy with no fee. So you could either go out and make 6% yourself, or you can make 18 minus 1 on some indexes that insurance companies are able to leverage and manage differently. Shoot, I'd pay 5% fee for that thing. Now, they don't charge that, thankfully. But if you want an income guarantee, maybe you pay a fee for, maybe 1 or 1.5% sometimes to guarantee that the company, even if your account runs to zero and you're 95 years old, that they'll continue to send you $3,000 a month or whatever the annuity pays. There are reasons to pay fees. And if it gives you value, pay the fee. If it doesn't give you value, don't pay the fee. That's what I tell people when they come here. I mean, if you want to use this and have all the value that we provide, then don't complain about the fee, because it keeps the lights on here. It keeps us available for you. It keeps us doing your tax planning, looking over your financial plan, making sure you're in the right investments, answering your questions, answering the phone call when you call, or responding to an email when you have a question of, hey, should we have more bonds? I'm worried about the election. Or, hey, I'm getting closer to retirement. I just feel uneasy about half my money at risk in the market. Is it time to pare back? Yeah, you have somebody to bounce those things off of. And if that's worth paying a fee for, then pay a fee. If you want to be a do-it-yourselfer, and you're obviously not, because you're already calling me to ask me a question. So, I mean, obviously you want something, yeah, right? You want some value added, and we're giving that to you free on the radio. But, as a client, we'd expect that there be some sort of a fee schedule that would keep everybody available to you to give you the services that you want. And if those services are incredibly good, you might be an incredibly good fee. So don't be a fee weenie. And I say that is because if all you look at is a fee, then you shouldn't buy anything, because everything has a fee. By the way, a CD has a fee. You know what it is? No, they don't. CDs don't have fees. I'm just buying CDs because I don't like paying you the fee. People tell me that sometimes. Like, well, okay, fine. Well, then ask the banker next time you have a tax question of how to, whether or not you should convert to a Roth. Ask your banker next time, whether you should go into bonds or you should use leveraged ETFs or buy an annuity. They don't know that. How are they going to create income for you? They don't really do a plan. Ask them to give you a lifetime income plan that looks out for the next 30 years and monitored every year. They're not going to do all that stuff for you. And by the way, CDs do have a fee. I started a bank. I don't know if I've mentioned that before, probably a few times. And I sat on the board, and I know how banks make money. And it's basically just margin. They're going to loan your money out, charge fees every time they give a loan. They're going to raise 7 to 10% on your money minimum, and they're going to give you 4 or 5 for a CD. So what? So what's the fee? Well, shoot, they're loaning your money out at 5 or 10%. Well, you could probably go make those same loans if you looked around and found people that borrow money. If you had the money, right? Well, you do have the money. You give it to them to loan out. Well, their work requires them to make 4 or 5% on your money, but you don't complain about the fee on a CD. They're making tons of money on your money. So what do? Well, I'm happy I'm making 5%. Well, you should just worry about the net that you make. What you keep that matters, what the benefit you receive matters. If you're getting tax planning, income planning, financial planning, tax returns done at a discount at your advisor's office like we have, help with choosing your Medicare or Advantage plans, even brokering those when it's needed, getting a reverse mortgage if you ever want to take money out of your house. You can't usually do that all under one roof. And you can't usually do that here unless some of your money has a fee attached to it. So, and I'm not trying to justify my fees, but I will. I mean, if you work here with us, you'll find that you get a ton of value. But somebody might say, oh my gosh, that's a big fee. Well, is it? Compared to what? Are they going to do all the same stuff for you? So again, 401ks might seem to have a lower fee, but you're the one in there making the decisions on what to invest in. You have to choose between that big list of asset allocations of what to pick. You don't get a hand-holding advisor to do all that stuff for you. So bottom line is, don't be a fee weenie. Just make sure that if you do pay a fee, you get some value for it. And if you don't, look for somebody else that's going to provide that value. I don't hold anybody hostage here. If they like the fees they pay, they stay. And if they don't, my job is to give them enough value that they want to stay and they're happy about paying a fee. So again, just maybe change your perspective on that. Look around and make sure that if you are paying a fee, you're getting value for it.
And Terry, we invite you to give us a call here at Premier Retirement, 520-780-9059. Come and sit down with Jeff and have that conversation. And again, we appreciate you listening to us in Oro Valley. You'll get Jeff's book, Retirement, The Road Ahead. Next question, Jeff, is David in Catalina Foothills. David says, I'm a 63-year-old man with $50,000 in a 401k. I don't have a lot of faith in the stock market anymore, even though it's gone up lately. I'd like to know if moving most of it to a gold and silver IRA would be a smart way to keep what little I have.
Well, frankly, I don't like gold and silver IRAs. They say that it actually has physical gold and silver attached to it. I don't know if they really leverage that and they just have a deposit of that gold and silver they can give you if you ever did cash it in, or if they just give you a number, have your money, invest it, and say they'll buy the physical gold at the time you might want it. So, I don't believe that you'd be keeping that gold and silver in your safe or in your house. If I'm going to own gold and silver, I'm going to own coins or ingots or bars or whatever that I can keep in my safe. Or if I want the upside of the gold and silver market because it's a hedge, I would buy an ETF, an exchange traded fund. And I would also do that in a 401k. Now, if $50,000 is the sum total of your retirement savings, I wouldn't put all of it in gold and silver, but maybe 20 or 30%, maybe 15,000 of it perhaps in an ETF. There's one called GLD. That's an ETF. It's a spider share. And there's another one, IAU. I like IAUM, which is mini, but it has a lower fee. And that's an iShares gold ETF. Very, very small fees. And you get basically the spot price of gold. If gold goes up, you make money. If gold goes down, you don't make money. If you buy and sell it, you don't pay a big commission. If you buy and sell gold, the lowest commission I found in town lately, because I did just buy actual physical gold recently, and I'm not necessarily making that as a recommendation. I'm just saying I did because I felt like I needed to continue to grow my diversified assets equivalently. So I added a little bit of gold, but I couldn't find anybody that would do it for less than 6% commission. Going in and going out. It's a little higher because it's getting to be a higher demand item. But if some of these gold IRAs have a 10% cut on the top, 10% on the back end, that means you're losing 20% to get in and get out of gold. I don't think that's a very good investment, just from the standpoint that it has to make 20% before you can actually make a dime when you get out, if you plan to get out of that. So it's not really money you can use. And if $50,000 is the sum total, I think you need to keep all that liquid. So use ETFs if you're going to buy gold and silver in an IRA. And I would change the 401k to an IRA and do your, manage it yourself, or find an advisor that is willing to do that, the ETFs. And also, be a little bit more conservative in the context that you and I too don't have a lot of faith in the stock market anymore, because it's being manipulated and we're being lied to about the economy, and jobs aren't what they really are. Earnings aren't up for companies. Growth isn't up except for a few AI companies that stand out from time to time. But there's just not a lot of things to put faith in the stock market, other than the fact that we keep seeing it go up every day, and that's not fundamentally a good reason to put your money at risk, in my opinion. So keep thinking like you're thinking. Hedging is good, but I think short-term bonds for most of it for now, until the market might have a little correction, or until we get at least through the election and the inauguration and see what happens first of the year going into the new the new term of our new president. So anyway, we have to weigh all that. But again, if you have other assets, I need to see the whole picture before I can give you a better answer. But I think that's the best answer I can give you if all you have is $50,000 and that is your nest egg.
We appreciate you listening to us, David in Catalina Foothills. And again, our number 520-780-9059 if you want to come in and sit down with Jeff and talk about your situation. If you got a question you'd like to ask us and get it answered on the air, you can get it to us by calling it in to Shelley if you'd like, 520-780-9059. You can also go out to our website, which is premret.com, PREMRET.com, and put it in the contact page there. If we use your question, of course, we'll send you out Jeff's book, Retirement, The Road Ahead. You're listening to Premier Retirement with Jeff Vogan, founder and president of Premier Retirement Planning and Wealth Management right here in Tucson, also with an office up in Mesa. Again, if you would like to get your no-cost, no-obligation Premier Retirement Roadmap, very simple, 520-780-9059. It's just a casual conversation between you and Jeff to answer the questions that you need to put you on a path towards a confident retirement. And again, no cost, no obligation for that whatsoever. Jeff, last week we began a conversation about 7 ways to invest for income. The topics that we talked about were cash deposits. We talked about bonds. We also talked about preferred stocks, and we began to talk about dividend-paying stocks. So let's pick it up right there. Can you refresh for our listeners what dividends-paying stocks are and how they might be used in a portfolio?
Well, a lot of people like dividend stocks because they don't have to really worry about the daily fluctuations of the price of the stock if they are using it for interest to live on in retirement. There are some things about dividend stocks that may only be found out the hard way, and that is dividend stock prices can plummet just as well, in some cases more harshly, than growth stocks or stocks in a typical market crash. So if you did need to liquidate the actual asset and weren't able to hold it for the rest of your life to get interest or to get those dividends, you might end up getting caught. The other thing is with dividends, it's not necessarily a good thing, is the dividends that they pay on stock, you get taxed on regularly, whether you spend the money or not. You get the dividend, either it gets reinvested, you get a 1099 for the gains, or you get you have to figure out the gains on that and pay taxes on them as you go. And then they become new principal, and then you get taxed on the new dividends on a higher amount if you do dividend reinvesting, or if you take them out and use them, you pay taxes on them. You could do a dividend type portfolio, dividend stock portfolio, if you just wanted the steady growth, and look at things like there's a lot of energy stocks, or there's like energy transfer companies, pipeline stocks and things like that transfer gas that typically pay a nice dividend, mostly in the utility type field. But those stocks have a tendency, because as the country gets better and more and more people get born and immigrate here, there's more and more need for power and those utilities to get to different areas. And so they're kind of an ever expanding type of a company just based on their own growth track. Plus they pay a nice dividend of maybe 6, 7, 8%. So, there are some things that are a little bit less volatile. I would be, a little bit, less interested in buying IBM because it pays a 2.5% dividend than I would be a company called Energy Transfer, for example, that does pipelines and pays a 7.5% dividend payout. And, it's been growing at 25, 30% per year for the last few years. So IBM's grown like crazy the last few years, but it just, fell like 10 or 15% a few weeks ago. So, you have different ways to play dividend stocks. Just keep in mind that they're just as risky as regular stocks. I would prefer to use kind of a preferred interest on the dividends, or to look at something that gives you a little bit more fixed interest and maybe has a little bit less risk, at least for most of my retirement clients. However, we do have a dividend portfolio that's an exchange traded fund that I like, because you don't have to pay interest on the gains as they come. You only pay tax when you sell it. And if you hold it more than a year, you get long-term capital gains tax treatment instead of ordinary income tax treatment by paying taxes on the dividends along the way. So again, a lot of ways to skin the cat, just a few there.
7 ways to invest for income. That's what we're talking about with Jeff Hogan here of Premier Retirement. Jeff, a lot of people think that real estate is a good way to go, but I think if you're in retirement, you're a little bit older, active real estate is maybe not a great idea, because of course it takes a lot of work to keep that going. But let's talk about REITs, real estate investment trusts, as a way to get into real estate and maybe have some investment income.
Right. If you don't want to do your, your own management and be hands-on, because, managing real estate is another job. It might be a part-time job, and maybe you want it, because you still like tinkering and fixing toilets and doing a few things, odds and ends here and there. Maybe it keeps you busy. Some people really love real estate in retirement. However, most of my clients that I'm seeing probably the last few years want to get out of real estate, just because even though it's appreciated, first of all, they can take some profits. The other thing is they're just kind of tired of having to deal with turnover, dealing with tenants, dealing with having to, raise rates because inflation's, hurting them just about as everybody, and they've got to be the bearer of bad news, and they don't want to do that. So you can actually buy a portfolio of real estate in what's called a real estate investment trust. There's a few different variations of that. I don't particularly like real estate investment trust as an organized, a security where they say, hey, we're going to raise $1 billion, we're going to buy apartment buildings, and then when we sell them in 5 or 10 years, we'll distribute the profits. And by the way, we're going to pay you 7% along the way. Well, while they're getting that money in on a new investment real estate trust, a real estate investment trust, they have to pay that interest out of the new money that comes in, because they haven't actually generated any interest from the real estate. And oftentimes, even though they say they're going to raise $1 billion to invest in $1 billion worth of real estate, they don't end up having, once the funds are raised, if the real estate hasn't appreciated at 7%, then they end up with $500 million of real estate instead of $1 billion. I'm kind of using some generalities here. But they come up short and then say, well, at least now we're making this much interest. Well, we can pay you 4% on your money now because it's only worth this much. And if you want to sell, guess what? You only get half your money back. And then they'll say, oh, yeah, but you got 6 or 7 years of 7% interest. So you already got half your money back, and you're still going to at least better than break even. Well, that's not really what you signed up for. And those are kind of give bad names to REITs. Now, there is a phase where that type of a REIT, where it's kind of a new investment REIT, becomes what's called a publicly traded REIT, where once that investment sells out and they pay everybody, all the initial investors off, or they convert it to stock, and then it's a tradable asset. And at that point, it trades based on the value of the real estate as it goes up. The only way I would get into real estate investment trust, just based on my history, is never to buy a new offering. My son actually was an auditor at Deloitte, and he came home one day and he was actually auditing a real estate investment trust company, a very, very popular one out of Phoenix. I won't name a name just because there's a few of them you could probably guess. But he says, Dad, isn't REITs kind of like a Ponzi scheme? I said, what do you mean? He says, well, they use new investors' money to pay all the interest. They're not actually making money on that money for years, and there's no telling if they will or won't. If there's a bad real estate environment, they lose money. If there's a good real estate environment, they might make money. But people who organize the REIT are the ones that make a killing. He says, this company's just making a killing. He says, but I don't see the returns coming to the clients because they're all getting cannibalized from the investment themselves. And I said, yeah, that's kind of how they work. And I learned that several years ago when I sold some REITs and they didn't turn out very well. And I decided I wasn't going to do that anymore. So if you're going to do REITs, look for a real estate investment. I like ETFs, an exchange traded fund that has real estate in it. There's some real estate exchange traded funds I like even better than REITs, but there are some real estate investment trusts, because they are traded based on the actual fair value of the real estate in that. They've already gone through all the money-sucking events that happen to all the originators of the real estate trust, and now it's just a security that trades in the open market. That's really the only way I would own it, either a tradable real estate investment trust or an exchange-traded fund.
We've been talking about 7 ways to invest for income with Jeff Hogan of Premier Retirement, and we have talked so far about cash, bonds, preferred stocks, dividend-paying stocks, and of course, REITs. And again, Jeff will continue this conversation next week. We'll wrap it up next week by talking about ETFs, multi-asset income investments, and also annuities. If you've got questions for us, you'd like to get in and sit down with Jeff, talk about your own individual situation, again, 520-780-9059 is our telephone number. You can also find out more about us online at premret.com, premret.com. Jeff, we're out of time for this week. I want to thank you for your time, but most importantly, of course, thank our fine listeners here in the greater Tucson area for joining us. For Jeff Hogan, I'm Jeff Shade. Have yourself a great weekend. We'll talk to you again next week with another edition of Premier Retirement right here on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.